Okay, hello everyone, welcome to my first video on investing mastery. As the title suggests, this video is my take on Tobias Carlisle's The Acquirer's Multiple. This book has literally changed how I've been investing ever since I read it. Completely. I used to subscribe to Warren Buffett's long-term buy and hold view on investing, and I still do, don't get me wrong. But the arguments Tobias presents in this book are so solid I had to at least give it a try. So, what is the Acquirer's Multiple? In Carlisle's own words, it's when the crowd zags, zig. Many of you that know of Warren Buffett knows that one of his investing philosophies is to be fearful when others are greedy and be greedy when others are fearful. Carlisle is just saying the exact same thing here, but is using mean reversion to back it up. His basic idea is that businesses will always revert to the mean. The mean is the average and is shown in this dotted line here. What Carlisle was saying is that a business in a bad situation, or a business currently being looked at in a bad light, will most likely revert back to this mean or average. Taking that a step further, he concludes that buying a group of these bad bunch businesses will give you a greater market return as they revert back to the mean, enjoying that rise in value as they do. So let's just pause and look at this for a minute. When you think about it from this view, it sort of makes a lot of sense. If you buy bad bunch businesses, you're always buying at this low point around here, or near enough this low point. But when you buy businesses that are trending or are favourable among the general population, you're always buying businesses that are around this area here. This means that there is nowhere to go for those businesses but down, resulting in a below average market return. And I'm trying to be nice about that as well. I mean, you'd have to be really unlucky to buy a company right at the top of the peak before it comes back down. So I've said you're likely buying it somewhere on the way up. So more than likely, even after you buy it, the stock will continue to rise a little bit before coming back down. But according to Carlisle, come down it will, and you'll be worse off for it returns-wise had you gone with the underperforming stocks, the bad bunch, the majority of which have been reverting their way up to the mean through higher share prices. So this is all well and good, but why do stocks revert to a mean? Where's he got that idea from? That's a very good question. I was a bit sceptical at first as well, but he goes on to say that it actually follows well-established market cycles. So if we look at this slightly altered image, we can see what happens to a business in its market over time. So the company will start off in a highly profitable business. I mean, why else would they go into a business in the first place if they couldn't make a profit, right? But then other companies see that their profit margins are high and want some of that profit. So they then enter into the same market and compete alongside that company. Over time, this leads to more competition, which, as we all know, brings down prices and consequently profit margins. And just to be clear, this isn't just Carlisle saying competition reduces profit. This is a well understood and studied economic principle. If you're interested and want to look into that aspect further, look up perfect competition. Enough about the theory. The question I'm sure you're all wondering, and the answer to which persuaded me to adopt this investing technique: does the acquirer's multiple deliver? So I'm about to show you 3 graphs Carlisle shows in his book. Just some things I want you to know before I show you them. First off, these graphs show a back-tested portfolio of 30 stocks in the S&P 500 from 1973 to 2017. And then secondly, he compares his acquirer's multiple results to Joel Greenblatt's magic formula, as well as the S&P 500 results as a whole. Joel Greenblatt's magic formula was described in his book, The Little Book That Beats the Market, which I actually haven't read yet. If you're interested, let me know and I'll do a review similar to this one on that book as well. So, does the acquirer's multiple deliver? Yes. Carlisle has broken his categories down into 3. Market cap of 50 million and above, market cap of 200 million and above, and lastly, market cap of 1 billion and above. As you can see, in all 3 scenarios, the acquirer's multiple handily beats the S&P 500, while also beating Greenblatt's formula in all 3 scenarios. What do you think? I'll wrap up the video there. If you're interested in learning more, please buy the book. It's such a good read and I would highly recommend it. I hope I've at least intrigued you a bit to want to go out and find out more for yourself. If I have, let me know by liking the video and subscribing to my channel. Thank you very much and I hope to see you in the next video.